management of a smaller company. They're not just hoping for the best, they have a proven playbook they're executing. Looking at their recent performance, Kistos has been actively making acquisitions across the North Sea and the Netherlands, building up a portfolio of gas assets that are crucial for Europe's energy security. With the ongoing geopolitical tensions and the continent's push to move away from certain energy suppliers, domestically produced natural gas is incredibly valuable. This puts Kistos in a very strategic position. They're not just selling a commodity, they're providing a solution to a massive political and economic problem, and that kind of strategic importance can command premium pricing and stable demand for their product. The growth potential here is twofold. First, there's the operational growth from optimizing the assets they already own and bringing new projects online. They can increase efficiency, cut costs, and boost production from their existing portfolio. Second, and this is the really exciting part for a company of this size, is the potential for more acquisitions. They have a strong balance sheet and a management team that is constantly on the lookout for the next deal. Another smart acquisition could significantly re-rate the stock overnight, and that's where the explosive penny stock potential really comes into play. In terms of the broader sector, the energy market is notoriously volatile, which is both a risk and an opportunity. However, Kistos' focus on natural gas as a transitional fuel, cleaner than oil and coal but more reliable than renewables, places it in a sweet spot. As the world moves towards a greener future, natural gas will likely play a critical role for decades to come, acting as a bridge. For a small-cap company like Kistos, having this strategic relevance in a multi-trillion-dollar industry gives it a potential runway for growth that is hard to ignore. Keep a very close eye on this one. Moving on to our second UK pick, we're stepping into a completely different and, let's be honest, a very trendy sector, health and wellness. I'm talking about Cellular Goods, ticker CBX. This company is all about high-end consumer products based on cannabinoids, but with a major twist. They are focused on lab-made biosynthetic cannabinoids like CBG or cannabidiol. This is a big deal because it allows them to produce highly pure, consistent ingredients without the agricultural baggage, costs and regulatory hurdles that come with growing traditional cannabis plants. It's a science-first approach to a market that's often dominated by farming. The company was one of the first of its kind to list on the London Stock Exchange. And it initially got a lot of buzz, partly because it has backing from soccer legend David Beckham's investment vehicle DB Ventures. Now, celebrity endorsements can be a double-edged sword. Sometimes it's just hype. But in this case, it provided the company with significant brand visibility and credibility right out of the gate, which is something most penny stocks can only dream of. Getting your brand in front of millions of people is a huge marketing advantage. However, let's be real, the stock performance since its IPO has been, well, it's been rough. Like many early-stage wellness and cannabis-related companies, they faced the harsh reality of building a brand, educating consumers, and generating sales from scratch. The initial hype faded, and the share price came way down. But this is exactly why it's on my watch list now. The company has survived the initial cash burn phase. They've launched their product lines of skincare and supplements, and they're starting to build a loyal customer base. The valuation is now a fraction of what it once was, meaning the risk-reward profile has shifted dramatically. The growth potential is pretty clear if they can execute. The global wellness market is enormous, and the niche for premium science-backed cannabinoid products is growing fast as consumers become more educated. If Cellular Goods can establish itself as the go-to brand for high-quality lab-grown cannabinoid products, the upside is massive. Their success hinges on marketing, brand building, and expanding their product range. They need to convince consumers that lab-grown means purity and quality, not unnatural and synthetic. It's a marketing challenge, but one with a huge potential payoff. The sector itself is still in its infancy. Regulations around cannabinoids are evolving, and public perception is slowly but surely shifting from a recreational drug mindset to a wellness ingredient one. Cellular Goods is positioned at the premium scientific end of this spectrum, which could insulate it from the race to the bottom price wars we see in the lower quality CBD market. It's a speculative play, no doubt about it. but you're betting on a strong brand, a unique manufacturing process, and a massive growing consumer trend. This is a classic high-risk, high-reward penny stock scenario. Our third UK stock is a unique one that I find fascinating. It's Tekcapital, ticker TEK. This isn't a company that makes one specific product. Instead, think of them as an intellectual property or IP commercialization company. What they do is they find groundbreaking inventions and scientific discoveries, usually from universities, and then they help turn that raw IP into a successful standalone business. They provide the funding, the business expertise, and the network to take an idea from a university lab to the global market. It's like a publicly traded version of Shark Tank, but focused on deep tech. Tekcapital's portfolio is the key to understanding its value. They have several subsidiary companies, each based on a specific piece of technology. For example, their company Ceres has developed a low-sodium salt alternative called microsalt, which is a huge deal for food manufacturers trying to make their products healthier. Another one, Qudian, is developing software for remotely monitoring and controlling autonomous vehicles. Each of these portfolio companies is a potential home run in its own right. As an investor in Tekcapital, you get exposure to all of them. The performance of Tekcapital stock is directly tied to the perceived value and progress of its portfolio companies. When one of them announces a new partnership, a successful trial, or a major sales agreement, Tekcapital's stock tends to react positively. The share price has been volatile, as you'd expect from a company whose value is based on future potential rather than current stable earnings. It's a sum-of-the-parts valuation story, and right now the market seems to be pricing Tekcapital at a significant discount to the potential standalone value of its subsidiaries. This is where the growth potential gets really exciting. Tekcapital's ultimate goal is to grow these portfolio companies to a point where they can be sold off or listed on the stock market themselves through an IPO. A successful exit for even one of its major holdings, like Ceres or Qudian, could result in a massive cash windfall for Tekcapital. This cash could then be returned to shareholders as a special dividend or reinvested into finding the next big university invention. It's a self-sustaining cycle of value creation, and we are at a point where some of these portfolio companies are getting mature enough for a potential exit event. The sector, if you can call it that, is venture capital and IP commercialization. It's inherently risky because not every invention will become a commercial success. Many will fail. However, the venture capital model is built on the idea that just one or two massive winners can more than pay for all the losers. By investing in Tekcapital, you're essentially getting a diversified portfolio of high-tech ventures curated by an experienced team. For a penny stock, this diversification is a huge advantage compared to betting on a single product biotech or mining company. It's a bet on the management's ability to pick and nurture winning technologies. All right, let's turn our attention to the clean energy space with our fourth UK pick, Ceres Power Holdings, ticker CWR. This is not your typical solar or wind company. Ceres is a technology company at its core, and they've developed a world-leading fuel cell technology called solid oxide fuel cells, or SOFC. In simple terms, these cells can generate power from conventional fuels like natural gas, or from green fuels like hydrogen. And they do it incredibly efficiently and with very low emissions. They can be used in everything from data centers and commercial buildings to electric vehicle charging stations. What makes Ceres so compelling is their business model. They don't want to be a massive manufacturer of the final products themselves. Instead, they follow a high-margin licensing model. They partner with global manufacturing giants. I'm talking about companies like Bosch in Germany, Weikai in China, and Doosan in South Korea. Ceres provides the core fuel cell technology and the IP, and these massive partners handle the manufacturing, distribution, and sales at a global scale. Ceres then collects royalties on every unit sold. This is a brilliant, capital-light way to scale. The stock performance has been on a wild ride. A few years ago, Ceres was a market darling, and its stock price soared as the hype around the hydrogen economy reached a fever pitch. Since then, the market has cooled off, and concerns about the timeline for mass adoption have brought the share price all the way back down into penny stock territory, or close to it, depending on the day. This is a classic case of market sentiment overshooting on the way up and now arguably overshooting on the way down. The technology hasn't changed, the world-class partners are still there, but the valuation is now much more grounded. The growth potential is simply immense. We are talking about disrupting the multi-trillion-dollar global power generation market. As the world pushes for decarbonization, technologies like Ceres SOFC are going to be critical. Their fuel cells can provide stable, clean power when the sun isn't shining or the wind isn't blowing. The big catalyst for shareholders will be the transition from licensing fees, which they are already earning, to significant recurring high-margin royalty revenues as their partners start mass production. Each new factory built by Bosch or Weichai represents a future stream of royalties for Ceres. The clean energy sector is only going in one direction, up. While there will be bumps along the road, the global commitment to fighting climate change is undeniable. Ceres is a technology enabler at the heart of this transition. The risk is all about timing. How long will it take for their partners to ramp up to mass production? It's a waiting game. But the partners they have are some of the biggest engineering companies in the world. They aren't partnering with Ceres just for fun. They're doing it because they see a massive commercial opportunity. This is a long-term play on a world-class technology company that's temporarily out of favor with the market. For our final UK pick, we're digging into the mining and commodities sector with Eurasia Mining, ticker EUA. This company has been on the radar of penny stock investors for a long time, and for good reason. Eurasia Mining is focused on the exploration and development of platinum group metals, primarily palladium and platinum, as well as rhodium, iridium and gold. And their main assets are located in Russia. Now, I know what you're thinking, and yes, we absolutely have to address the giant geopolitical elephant in the room. Eurasia's main claim to fame is its world-class West Kytlim project, which is one of the largest alluvial PGM deposits in the world. They also have the Monchetundra project, which has enormous potential. Russia is a mining superpower and a major global supplier of these metals, which are critical for things like catalytic converters in cars to reduce emissions and in the growing hydrogen economy. Before the conflict in Ukraine, Eurasia was on a clear path, developing its assets, and was even in discussions for a potential sale of the company to a larger player. Obviously, the geopolitical situation completely changed the game. The stock price collapsed as the risks associated with operating in Russia became impossible for the market to ignore. The company has been in a state of limbo, unable to advance its projects in the way it had planned and facing immense difficulty in its previous plan to sell its assets. This is the definition of a distressed asset. The company's market capitalization is now a tiny fraction of the independently verified value of the metals in its deposits. So, where is the growth potential? It's a highly speculative, binary bet on a resolution. The company's management has been working to find a way forward, which has primarily involved trying to sell its Russian assets. If they can successfully execute a sale, even at a steep discount to the pre-conflict valuation, it could result in a massive return for shareholders at the current share price. The entire investment thesis hangs on the company's ability to monetize these world-class assets in an incredibly challenging political environment. It's a bet that management can pull a rabbit out of a hat. This is by far the riskiest stock on our UK list today. You're not betting on geology. The value of the metals in the ground is well established. You are betting entirely on geopolitics and corporate maneuvering. A positive outcome, like a successful sale, could lead to a 10 times or even greater return. A negative outcome, where the assets are stranded or nationalized, could mean the stock goes to zero. It's the ultimate high-risk, high-reward penny stock. This is not for the faint of heart, but for those with a very high tolerance for risk. The potential upside is astronomical, and it's a situation worth monitoring very closely. All right, let's cross the pond to the United States for our first US penny stock pick, Sunworks, trading under the ticker SUNW. We're staying in the clean energy theme, but this time with a focus on solar. Sunworks is a solar energy company that designs, installs and manages solar power systems for a wide range of customers. They're not manufacturing the panels themselves, they are the installers and integrators. working with agricultural, commercial, industrial, and residential customers primarily in the western United States, especially California. Think of them as the essential hands-on part of the solar revolution. While big companies make the panels, it's companies like Sunworks that actually get them onto roofs and into fields where they can generate power. They handle everything from the initial consultation and system design to the permitting installation and ongoing maintenance. This is a service-based business in a booming industry, which can be a great place to be. The demand for their services is directly linked to the overall growth of solar energy adoption. Sunworks stock has had a very volatile history. It has seen massive spikes in price, often tied to government policy announcements like the Inflation Reduction Act, which includes huge incentives for solar installations. However, it has also faced significant challenges. The installation business is competitive and profit margins can be thin. They've struggled with profitability and have had to raise capital, which has diluted shareholders and put pressure on the stock price, bringing it down into deep penny stock territory. The potential for growth, however, remains significant. The underlying demand for solar is not going away. In fact, it's accelerating. States like California have mandates for solar on new homes, and businesses are increasingly turning to solar to cut their energy costs and meet ESG goals. If Sunworks can streamline its operations, improve its profit margins, and effectively manage its costs, it is perfectly positioned to ride this massive wave of demand. The challenge is execution. They need to prove to the market that they can translate revenue growth into sustainable profits. The solar sector is red hot, but being an installer is a tough gig. It's a game of volume and efficiency. The bull case for Sunworks is that at its current very low market cap, it's undervalued relative to the huge market opportunity it's addressing. A few good quarters of improved profitability or a strategic partnership could cause a major re-rating of the stock. The risk is that they continue to struggle with margins and cash burn. It's a turnaround play in a sector with a massive tailwind, and if they can get the execution right, the upside from these levels could be substantial. Our second US pick takes us into the exciting world of medtech. I'm talking about HeartBeam Inc, ticker beat. This is a development stage company with a technology that I think is honestly incredibly compelling. They are working on a personal, portable and easy-to-use vectorcardiography device, VCG for short. Now, most of us are familiar with an electrocardiogram, or ECG, which is the standard for monitoring the heart's electrical activity. HeartBeam's technology aims to take that a step further by providing a much more detailed, three-dimensional view of the heart's electrical signal. The core product they're developing is a credit card-sized device that a patient can simply hold up to their chest. This device works with a smartphone app to capture a detailed VCG signal and sends it directly to their doctor or a monitoring center for immediate analysis. The goal here is to help physicians more accurately and quickly diagnose a heart attack. Right now, when someone has chest pains, it can be very difficult to determine if it's a true cardiac event or something else, often leading to costly and unnecessary emergency room visits. HeartBeam's technology aims to solve this problem. As a pre-revenue medtech company, HeartBeam's stock price lives and dies by clinical data and regulatory milestones. They are currently in the process of seeking FDA clearance for their technology. The stock is in deep penny stock territory because, well, there is no product on the market yet and there's no revenue. Investors are betting on the technology's potential and the management's ability to navigate the rigorous FDA approval process. Every press release about a successful study or a positive interaction with the FDA can cause huge swings in the share price. The growth potential here is astronomical if they succeed. The market for cardiac monitoring is billions and billions of dollars. A device that can empower patients to take their own detailed heart readings at home and allow doctors to triage them more effectively would be honestly a game changer. It could save lives, reduce healthcare costs, and become a new standard of care for patients at high risk of heart disease. The upside isn't just a few percentage points, it's the potential to become a major player in a massive medical market. This is the classic biotech or medtech penny stock play. You have a potentially revolutionary technology, but it's facing the binary risk of regulatory approval. If they get the green light from the FDA, the stock could multiply in value overnight. If they face a rejection or a request for more lengthy and expensive trials, the stock could plummet. It's a bet on the science, the clinical data, and the regulatory outcome. For investors who can stomach that kind of binary risk, HeartBeam represents a massive potential reward for solving one of the biggest problems in healthcare. Sticking with the healthcare theme, our third US pick is T2 Biosystems, ticker T2. This company is all about diagnostics, specifically the rapid detection of sepsis and other bloodstream infections. Now, sepsis is a life-threatening condition where the body has an extreme response to an infection, and it's a leading cause of death in hospitals. The problem is that traditional methods for identifying the specific pathogen causing the infection can take days. And with sepsis, every hour of delay in giving the right antibiotic dramatically increases the risk of death. T2. Biosystems has developed a technology platform, the T2Dx instrument, that can identify the specific pathogen directly from a blood sample in just 3 to 5 hours, not days. This is a monumental leap forward. It allows doctors to quickly administer the correct targeted antibiotic, rather than guessing with broad-spectrum antibiotics, which contributes to antibiotic resistance. They have panels that can detect the most common and dangerous bacterial and fungal pathogens that cause sepsis. It's a technology that directly addresses a huge unmet medical need. So why is this stock in the penny stock graveyard? It's a story of commercial execution challenges. While the technology is fantastic, getting hospitals to adopt a new diagnostic platform is incredibly difficult and expensive. Hospitals have tight budgets, established workflows, and are slow to change. T2 has struggled to place as many of its T2Dx instruments as investors had hoped, and their revenue from the high-margin test panels has therefore grown slower than expected. This, combined with the need to raise cash, has crushed the stock price over the years. The growth potential, however, remains intact and is directly tied to a turnaround in their commercial strategy. They have a new FDA-cleared test for detecting a dangerous fungus called Candida auris and are continuing to expand their test menu. The key is placing more of their instruments in hospitals. Each new instrument placed represents a future stream of recurring revenue. From the disposable test cartridges, the company has been working on new sales strategies and partnerships to accelerate this adoption. A few quarters of strong instrument placements and test sales could signal to the market that the turnaround is finally happening. The diagnostics sector is highly competitive, but T2 has a unique FDA-cleared technology that offers a clear clinical advantage in a life or death situation. The investment thesis is a bet on a commercial turnaround. You're buying a company with proven, valuable technology at a deeply discounted price because of past commercial failures. If new management or a new strategy can finally crack the code on hospital sales, the revenue growth could be explosive, and the stock could re-rate significantly higher. It's a bet that the technology is too good to fail commercially forever. Let's shift gears into the world of high-tech and autonomous driving with our ninth pick overall, Aeva Technologies, ticker Aeva. Aeva is a LiDAR company, but they are not your average LiDAR company. LiDAR, which stands for Light Detection and Ranging, is a crucial sensor technology for self-driving cars, acting as the eyes of the vehicle by creating a 3D map of the world around it. Most LiDAR companies use a technology called time of flight, which sends out pulses of light and measures how long they take to bounce back. Aeva does something completely different, and they argue much better. They use a technology called Frequency Modulated Continuous Wave, or FMCW. Without getting too technical, this allows their LiDAR sensors to not only detect the position of an object, but also its instantaneous velocity. This means an Aeva-equipped car can tell not just that there's a pedestrian 50 meters away, but that they are walking towards the road at 2 meters per second. This is a huge advantage for safety and for predicting the future actions of objects on the road. Aeva came to the public market via a SPAC merger during the peak of the EV and autonomous tech bubble, and it did so with a very high valuation. Since then, the reality has set in that mass adoption of autonomous vehicles is taking longer than expected. The hype has evaporated, and the stock prices of almost all LiDAR companies, including Aeva, have come crashing down to earth, landing them squarely in penny stock territory. The company is still pre-mass production and is burning cash as it refines its technology and works to secure major automotive contracts. The growth potential is tied to winning one of these massive contracts. Aeva is working with some of the biggest names in the industry, including a production collaboration with Porsche and a partnership with the world's top truck manufacturer, Daimler Truck. A series production win with a major automaker is the holy grail for any LiDAR company. A single win could mean providing sensors for millions of vehicles over many years, translating into billions of dollars in future revenue. The entire investment case is built on Aeva's technology being chosen for a mass-market vehicle program. The autonomous vehicle sensor sector is incredibly competitive, with dozens of companies fighting for a limited number of design wins. The risk is that Aeva's technology, while impressive, gets beaten out by a cheaper or good enough solution from a competitor. However, the bull case is that their FMCW technology offers a distinct performance advantage that will be critical for achieving higher levels of autonomy, especially in complex urban environments. You are betting that in the long run, performance and safety will win out, and Aeva's unique technology will secure its place on the next generation of intelligent vehicles. For our final pick, we're venturing into the volatile world of Chinese fintech with Qudian Inc. trading in the US under the ticker QD. Qudian started its life as a major player in China's online consumer credit market, providing small unsecured loans to young consumers through a mobile app. At its peak, it was a fintech giant with a multi-billion-dollar valuation, originating huge volumes of loans and generating significant profits. They were a leader in a massive and rapidly growing market. However, the company has faced a brutal series of headwinds. The Chinese government launched a massive regulatory crackdown on the entire fintech and online lending industry, imposing strict new rules on interest rates, data collection, and lending practices. This completely upended Qudian's original business model. At the same time, intense competition and a slowing Chinese economy further squeezed their operations. As a result, their core lending business imploded, and the stock price collapsed by over 99% from its all-time highs. So, why on earth would we look at a stock with such a disastrous history? Because of the company's pivot and its balance sheet. Faced with the death of its primary business, Qudian has been attempting to reinvent itself. They've tried various new ventures, including a foray into luxury, ready-to-eat meals, which didn't pan out. This constant pivoting is risky and shows a lack of a clear long-term strategy. However, the one constant has been the company's large cash pile. Even after the collapse of its business, the company was left with a significant amount of cash and investments on its books. The investment thesis here is what's known as a net-net, or a deep value play. At certain points, the company's market capitalization has traded for less than the net cash on its balance sheet. This means you are essentially buying the cash in the company's bank account for, say, 70 or 80 cents on the dollar, and you get the remnants of its operations and any future ventures for free. The growth potential, or rather the value unlock, comes from the hope that management will eventually do something to return this cash to shareholders, either through a large dividend, a share buyback, or a liquidation event. This is a very specialized and risky type of investment. You are betting against the market's belief that management will waste the remaining cash on unprofitable new ventures. You're also exposed to the risks of investing in a Chinese company listed in the US, including the potential for delisting. It is a bet that the sheer mathematical value of the company's assets will eventually be realized. It's not a growth story in the traditional sense. It's a deep value special situation play where the upside comes from financial engineering rather than operational success. It's a fascinating case study for bargain hunters. So there you have it, 10 penny stocks across the UK and the US that I believe are worth watching in September 2025. We've covered everything from energy and mining to cutting-edge medtech and LiDAR. Now, I cannot stress this enough, this was not a list of stocks to go out and buy immediately. Please do not do that. Think of this as a launchpad for your own research and due diligence. Penny stocks are the definition of high risk, high reward. The potential for massive gains is real, but so is the potential to lose your entire investment. Each of these companies has significant hurdles to overcome, and their success is far from guaranteed. You have to understand the risks involved before you even think about investing a single dollar or pound. Now, I want to hear from you. Which of these 10 stocks did you find the most interesting? Was it the deep value play with Qudian, the revolutionary medtech of HeartBeam, or the geopolitical gamble with Eurasia mining? Let me know down in the comments below. Also, if you have a penny stock that you're watching closely that I didn't mention, share it with the community. I read through as many comments as I can, and it's always great to see what opportunities are on other people's radars. The best ideas often come from a collective effort, so let's get a good discussion going. And finally, if you got any value out of this breakdown and you enjoy this kind of deep dive financial content, it would be a massive help to me if you would smash that like button. It tells the YouTube algorithm that we're doing something right over here. And of course, make sure you subscribe to the channel and hit that little notification bell so you don't miss any future videos. I have a lot more content like this planned, and I wouldn't want you to miss out. Thank you so much for watching, and I will see you in the next video.